When it comes to the economy, the single most important metric that you need to be paying attention to and you need to understand today is the federal funds rate. Let's break it down right now. Today, we're going to be diving into a topic that has a very profound impact on the economy, real estate, what businesses do, and stock market, crypto, literally anything that has to do with finance and the economy, which impacts your wallet. It impacts inflation, and it goes all the way from top businesses, the Fortune 500 companies, all the way down to the little guy like you and me who are just trying to save up our money to invest. So let's talk about the Federal Reserve and their tool, which is often called the federal funds rate. In a nutshell, the Federal Reserve is the central bank governing the US dollar and the currency of the United States. They control the printing of money and they control the interest rate at which money gets lent out at. What happens is the Federal Reserve says we're going to basically lend money out at this rate. They then lend that money to other banks like Chase, JP Morgan, Bank of America, Citigroup, you name it. The Federal Reserve lends money out to other banks. Then those banks lend money to other banks and to businesses and to individuals. And so it ultimately falls down a waterfall path because the bank has to, like, let's for instance say Chase, right? Chase or Bank of America, if they get money from the Federal Reserve at 5%, they then have to lend that money out with a spread on top of that. So they are going to lend money out for maybe 6, 7, 8%. Because they have to make their money as well. So basically the Federal Reserve says we're lending money to the bank at 5%. Then the bank says we're going to lend money out at 8%, 9%. We're going to give people lines of credit at 20%. So all of these have a trickle-down effect in the economy. What the Federal Reserve sets for their funds rate is what trickles down into the economy. And usually when there's cheaper debt or it's cheaper to borrow money, meaning interest rates are very low, that creates a natural stimulus for the economy. Because if you have a low rate, like what we saw back in 2020, 2021, interest rates were very, very low. The federal funds rate was near 0%. I think it actually was at 0% at a certain point, which meant that debt was very cheap. When debt is cheap and you're able to arbitrage the debt by buying a property or by borrowing money to invest in your own business, that creates a stimulus, a natural stimulus in the economy because there's more money to spend. You can borrow more of it, and then you can then spread it out across your investments or across essentially naturally stimulating the broader economy. That's why paying attention to the metric of the federal funds rate, what rate that's set at, is actually very important to determining where the economy is at. When inflation got too high throughout COVID, the Fed had to essentially start hiking rates. They hiked rates all throughout 2023 and part of 2022 as well in order to curb inflation. And so far, it's actually been working. So where are we at currently with the current situation? Right now, going into 2024, the Fed has decided that they're going to be pausing interest rates. So they're stopping the rate hikes, but they're not going to start cutting yet. Most economists are actually predicting that they're going to start cutting rates going into 2024, probably by the summer, going into the fall. But this might not happen. In my opinion, I think it's going to stay a lot higher for longer. There's going to be a little bit more pain in 2024, maybe a slight recession, but we never know. No one has a crystal ball. But paying attention to the federal funds rate is just one of those variables that you need in your toolkit to determine where you're going to put your money, right? Because if you can put your money in a money market fund and get a higher yield than you would in the stock market, then you might want to put your money somewhere where it's going to get a better yield versus somewhere that it could actually lose value. So it determines a lot about investing and a lot about personal finance. So keep that in your toolkit. But the funds rate is not the only thing that the Federal Reserve uses in order to curb inflation or to control interest rates and monetary policy. There are a few other variables that the Fed uses. One is called the open market operations, and another is called the discount rate. Now, I'm not going to get too much into this. I'm not pretending to be an expert on this topic or anything. I don't really know too much about those particular variables. What I do know is that paying attention to how much money that they're printing, or qualitative easing there is versus qualitative tightening, and what interest rates are set at, are going to determine ultimately where you want to put your money and when is a better time to buy real estate, because I like to buy real estate. So for some historical context here, let's look back in time a little bit. Let's go back to the 2008 financial crisis, where we saw housing completely collapse. There's that big crash that we all saw, and everything really hit the fan, as you could say. What ended up happening back in those days is the Fed actually started cutting rates. They started dropping rates drastically in order to stimulate and prop up the economy. This is sort of similar to what they did during COVID. When COVID started, everything shut down, they cut rates and started printing money like crazy. And what actually, in my opinion, caused the greater amount of inflation is what's called the derivative of money printing. Because they're always going to be printing money. For instance, during the most recent banking failure at Silicon Valley Bank, when that failed, the Federal Reserve actually had to print more money in order to basically ensure all of those people who had the money in the bank at that bank that they wouldn't be losing their shirt, right? So when they keep money printing at a consistent level and they don't go up or down and influx it by a significant amount, inflation will stay roughly where it's been at historically, which is somewhere around like 2%. But then the second money becomes expensive or less cheap, everyone's going to pull their money out and cash in on their profits. But that actually creates the perfect buying opportunity for people who are waiting on the sidelines. Because now you get a better deal when there's fear in the market, like Warren Buffett always says, when there's blood in the streets, even if it's your own blood, that's the time that you need to be buying. When everybody's euphoric and everything's going up and everyone's like, oh my God, it's going to keep going up forever, that's the time that you need to be pulling back, taking your profits, and then waiting for everything to fall back down to then buy back in. That's all I have for you guys today. Thank you so much for being here. If you made it all the way to the end of the video, thank you so much for your time. Please consider subscribing, hit the like button for the YouTube algorithm, and I'll see you guys on the next video.